Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Earnings drag, equity futures dip as investors weigh corporate report cards ahead of the Fed's decision. Brace for impact. Ford suspends full-year guidance and says tariffs will hit profits. And a shock loss. Friedrich Merz fails parliamentary vote to become Germany's next chancellor. So we snapped 9 straight days of gains, over which we gained about 10%. We look to fall for a second consecutive day. S&P 500 futures down about 0.6%, nearly 1% for NASDAQ 100 futures. JP Morgan out with a note overnight saying the U.S. is no longer a safe place to hide. When it comes to this bond market, continuing to see yields starting to price out some of the cuts. We had strong ISM figures coming out yesterday. There was some concern underneath the surface. Prices paid, for example, got a little bit higher, employment a little bit weaker. Is it stagflation? Either way, we're looking at another gain in 10-year yields this morning, up nearly 2 basis points, trading at 436. That's your overall markets. Now let's get a look at some stocks to watch this morning. With that is Bloomberg's Joe Easton. Hey, Joe, great to have you back.
Hey, Danny. So Ford looking a little bit weaker in the pre-market today. We're down around 2.7%. The company pulling its guidance last night after the close. A lot of that due to the tariffs, and it does expect a $1.5 billion hit to earnings this year following the tariff impact. Then another stock sliding was Palantir. There we go. There it is, down 8%. Now, the company, the cybersecurity company, actually missing on some of the loftiest expectations, but actually talking about ravenous demand for cybersecurity spending in their earnings call. That stock, though, trading at around 200 times earnings, so we can see it coming off those high levels. Finally, a tasty deal over in the delivery space. DoorDash buying at the UK's Deliveroo, listed here in London. We are seeing DoorDash a little bit weaker. Deliveroo extending gains that we've seen following speculation of that report in London today. And all of this, as usual, on the Before the Bell opening wrap, available on the terminal.
A tasty deal. Oh, how we missed you, Joe, and your puns. Joe Easton there with the stocks to watch in the pre-market session. And in just a few moments, we're going to be speaking to Lucy Baldwin of Citi. Later in the hour, Torsten Slok of Apollo, along with an interview with State Street CEO Ron O'Hanley. Stay with us this hour for conversations you do not want to miss. But we do have a Fed rate decision coming tomorrow, the meeting starting today. Citi's Lucy Baldwin writing on the U.S. base cases now for Fed to start in June, but still with 125 basis point total in cuts. Less conviction on the timing than the size. The timing really just dependent on when the weakness starts to show up in the hard labor market data. And I'm pleased to say that Lucy joins us now. Lucy, so wonderful to see you this morning. The market is closer to 75 basis points, 125, 2 more cuts than anticipated. What gets us there? What changes in the hard data to move us forward to 125 basis points of cuts this year?
Hi, good morning. Thanks for having me. Yeah, so our expectation really here is that the US is heading for a stagflationary shock. We expect to see inflation data starting to pick up, which of course does create a tension for the Fed. But we really do expect that growth is going to slow quite meaningfully and for that to come through in the labour market. To your quote just there, I think the exact timing on that is where we have a lower conviction. Where we have the higher conviction is on that magnitude of cutting. Really, because of the magnitude of the growth shock that we think the United States is going to be facing on the back of tariffs. And of course, we know there's a lot of uncertainty around where these tariffs are going to land. But even our base case assessment is that you're likely to see these sort of 10% reciprocal tariff rates, 25% sectoral, probably 20% for Europe, probably something more like 60% as a base case scenario for China. And when you pull all of that together, that's a pretty big stagflationary shock that we expect the US to see. And of course, that's going to be felt effectively like a tax for the consumer. And we do expect to see this feeding through into the labour market. To your point, up until now, the soft data has been what has deteriorated. But we're expecting to see by the time we push through towards that June meeting, that is when we expect to see the labour market data really starting to shift in terms of jobs, in terms of starting to see the impact on hires, on quits, on some of those key data, and ultimately, of course, into the non-farm payroll prints.
Lucy, that view is an important one because we did hear from executives at Milken yesterday, and there seemed to kind of be this forming consensus. Mark Rowan, I think, put put it in a way a lot of people are thinking. Him saying that what the administration wants to do is not bad, but it's just the uncertainty of it in the back and forth. Lucy, is it the uncertainty, or to your point, is it simply the fact that it has been volatile? Or is it simply the fact, rather, that we're going to get tariffs at 10% and that enough is to cause the kind of ruptures that you're talking about?
Yeah, I think there would be a scenario under which tariffs in and of themselves wouldn't be recessionary and wouldn't feel recessionary in the United States or indeed globally. But I think this magnitude of uncertainty that is overhanging us is really going to start to be weighing on corporate expectations already. I mean, we've obviously already seen that in terms of the import data in that Q1 GDP print. We know that people are pulling forward certain purchases. We know that uncertainty is there. So we expect that to really manifest in terms of companies, in terms of what they're intending to do with their capex plans and hiring. So again, if you're a US company thinking about where you invest, at the moment that uncertainty is huge. And if you're, for example, an assembly plant in the United States, maybe buying components in from Mexico, you really don't know what you're dealing with and whether or not that plant in the United States is or isn't going to be competitive, depending on where the tariffs do or don't go. And so I think that uncertainty in and of itself is a huge thing. But I think even that said, even if we then got a greater degree of certainty coming through, there's going to be an element of damage that has already been done in terms of trust here, both in terms of the consumers and in terms of companies in the United States and, of course, around the world. And I think that's going to have knock-on implications in terms of growth and in terms of ultimately how people think about asset allocation and how much dollar exposure they're going to want to see and want to have in portfolios.
To that point, equities have started to rally off the back of this idea that there is going to be more certainty coming, that deals are happening. Lucy, are equities mispriced if we are going to be getting cuts, if the hard data is going to start deteriorating alongside the soft?
I think the markets today are not pricing any real recessionary risk here, and I think that is the challenge for investors at the moment. I think the sort of rally that you saw through April, through the back end of the month in particular, didn't have a lot of conviction to it, but I do think that the markets today really aren't pricing any meaningful slowdown. So, you know, our expectation of where tariffs go, combined with what we think is happening in terms of the labour market, because you've got to remember, from an immigration perspective, we're now going to see significantly less people added to the labour market. Again, that's likely to create some challenges around inflation, some stickiness there. And then I think a lot of the deregulation is really going to be much more back-end loaded. And then overhanging all of that as well is you've got probably as well quite big government spending cuts that are going to be needed in order to keep control of the back end of the curve, given the US debt situation. And again, those things are going to be challenges. So I think when you pull all of that together, the market's really not pricing the full impact of those things to our mind. For us, we think that there are probably now better opportunities outside of the US equity market. We'd look at markets such as Europe, and we'd look at markets such as Japan. Europe, I think, is a much clearer case where you're going to see easing quite materially coming through, because as we talked about, the Fed has got a much more complicated backdrop because of the inflationary pressures. Ultimately, we think that the growth concerns will win out for the Fed, but I think it's a more clear prescription for foreign central banks to ease. So that's one of many reasons why we like Europe here. And again, Japan would be another market where we see some opportunity. I think the US market would be much more selective how we think about that. We have a 5,800 price target for the S&P for the end of this year, and we would say that growth really is probably the new defensive in the US market, given how some of those stocks have traded, and given we think actually there's going to be more resilience in a number of those names, as of course we've seen with some of the big tech companies reporting more recently.
Yep, we're up just over 5,600 right now in the equity market, so a slight rally from there. Lucy, thank you so much for joining us this morning. Great to see you. That is Citi's Lucy Baldwin. Let's get you some other top stories now that are trending on the terminal this morning. China's services activity fell more than expected in April to the lowest level in 7 months due to the impact of tariffs. That stokes fears of a rapid slowdown in the second quarter after a solid start to the year. DoorDash, meanwhile, has agreed to buy UK-based food delivery platform Deliveroo for a value of about $3.9 billion. The deal will expand DoorDash's reach to more than 40 countries. Gross order of the combined companies will be about $90 billion, with about 50 million monthly active users. And Palantir falling quite steadily, almost 8% in the pre-market trade. It missed expectations. Growth was strong in the U.S., but the rest of the world fell short, which is less than 1/3 of its business. Palantir is the best performing company in the S&P 500 this year, riding a wave of AI enthusiasm. Coming up, a shocking setback from Germany's Friedrich Merz. The conservative leader fails to get enough votes to become the next chancellor. And breaking just moments ago across the terminal, German lawmakers won't vote again today on Merz as chancellor. We're live from the Bundestag next on your Bloomberg Brief. It's your Bloomberg Brief. I'm Danny Berger in New York. German Chancellor Friedrich Merz has failed to secure a majority in the initial vote to confirm him as Germany's next chancellor. The latest out of Berlin saying German lawmakers won't vote again today on Merz. Bloomberg's Oliver Crook is there outside the Bundestag. Oliver, he was supposed to be a shoo-in. This is such a shock. What went wrong?
I mean, Danny, this is the sort of day that was supposed to be a rubber stamp event to basically bring in the new chancellor of Germany, you know, Europe's biggest economy. You're going to have a handoff of power from the SPD, from Olaf Scholz to the CDU, Friedrich Merz, by 3 p.m. today. You had the early vote in Parliament where all the lawmakers assembled to get that 316 votes over the majority in order to basically continue with the procedural steps that would end with a new chancellor of Germany. That is not what happened. There was a complete explosion of basically all expectations here. It fell short of the votes, 310 votes. It shocked everybody in the room. You saw the chancellor, Olaf Scholz, his jaw dropped, shaking his head when he went to go consult with the other leaders of the different coalition and caucuses within the parliament. There was one person who was laughing audibly, very loudly within the auditorium, and that was the leader of the far-right AfD, Alice Weidel, who found it obviously hilarious and basically has been campaigning throughout this entire time on a platform that basically the German political establishment, mainstream parties, are broken and are not effective. The question is, what happens next, Danny? In order to answer that question, we all had to break out our German constitutions to figure out procedurally what happened, because this has literally never happened in modern German history. And what we understand from Article 63 of this constitution is that if that first vote fails, they will hold another set of votes. They can hold a number of different ones over the 14-day period of time. If those all fail, Danny, we are talking about potentially another election in Germany at a time when over the last couple of weeks we have seen for the very first time in German history the AfD, the far right, polling in some polls in the #1 slot. We should say that is not the base case scenario. We do not expect another vote today. We could have one as early as tomorrow. But this is a total bomb in the middle of the sort of German political establishment on a day that was supposed to bring in a new era of stability, fiscal stimulus, and bringing the economy back together. That is not what happened.
Oliver, first off, let me say you would have a pocket German constitution. Nothing about that surprises me. But second of all, what does this mean for the mandate that Merz was supposed to have, even if he is eventually sworn in as chancellor? The big projects that Germany was supposed to be undergoing, the spending on infrastructure, on military, do we need to question all of that now?
Listen, I think it shows you just how fragile the German political establishment is right now. If you cannot even get this grand coalition, we should say that the majority of coalitions in German history since the end of the Second World War and since the fall of the Berlin Wall have been the SPD and the CDU. This is a sort of normal arrangement for sort of politics as usual in Germany. This is not a rare coalition like we had the last time around, which was really kind of a slobby coalition of the Greens, the sort of liberals, and the socialists. If they cannot even get their acts together, it's a real question about how effective they're going to be at uniting the country. As you say, Danny, we have that €1 trillion worth of stimulus. Where does that leave things? How quickly can they deploy that? If there is this level of political disagreement, even in the early stages, how are they going to agree on how to spend and disperse that money? There is also the fact that Friedrich Merz needs to be a strong leader of Germany, not just to unite the country, but to be a presence on the international stage, to deal with Donald Trump, to lead within Europe, and also to potentially broker new trade agreements now that the U.S. is basically stepping out of the multilateral trading and neoliberal order. That's going to have to be Germany and Europe. This does not seem like a chancellor that is very strong. And of course, Danny, the other thing that it puts even more pressure on is this question of immigration. This has been the #1 topic for a number of Germans. This is definitely the #1 topic for the AfD. These are all the things that the chancellor now needs to tackle. He wanted to hit the ground running. He hasn't even hit the ground.
Oliver, just quickly before you go, is there a chance that Merz doesn't become the next chancellor now?
Listen, we've heard some commentary really in the first few minutes after this vote came out. Again, this is from parties a little bit more on the fringes. We heard from the left saying that basically if Merz and this coalition can't even get their act together in the Berlin bubble, how on earth are they supposed to unite the country? And that maybe Merz is not the right man for the job. And we should say, Danny, that in the lead up to this election, in the election campaign, there had been questions about whether Friedrich Merz would be the right man to lead Germany, whether he's not a very, popular politician domestically. This is not someone that has a huge amount of charisma and is able to rally a lot of people behind him. I think right now the base case is that will not happen. But again, Danny, we are operating in a world politically, not just in Germany, but globally, in non-zero chances of what happens in politics. So listen, we're going to have to watch it very closely. We'll have to keep you updated as this sort of unfurls and also see how the market takes it.
Really stunning news coming out of the Bundestag. Oliver, thank you so much for joining us this morning. That is Bloomberg's Oliver Crook. Let's get you some other top stories this morning and take a look at what's making the front pages and headlines around the world. The FT has this on their front page, that OpenAI is restructuring its for-profit division as a public benefit corporation. It comes after facing pressure from former employees, academics, and rivals, Elon Musk among them, who had been opposed to OpenAI's previous plan to convert into a for-profit company. The overall business will remain under the control of its nonprofit. Next up, the Washington Post leads with Israel planning to seize parts of Gaza and stay long term. The Israel Defense Forces will gradually enter to root out Hamas fighters and destroy their tunnels. Hamas has rejected the proposal unless Israel agrees to terms of an eventual withdrawal from Gaza and an end to the war. And on the front page of the Wall Street Journal, reporting that Defense Secretary Pete Hegseth used Signal more extensively for official Pentagon business than previously disclosed. Sources told the Journal that he set up many of the chats himself, sending text from an unsecured line in his Pentagon office and from his personal phone. The Pentagon did not respond to a request for comment. Now, coming up, Ford says that it could take $1.5 billion hit from Trump's tariffs. Shares move lower in the pre-market. We'll have more on the automaker's earnings next on your Bloomberg Brief.
Based on what we know now, our expectations of how certain details will resolve around tariffs, we've estimated the gross impact of tariffs for full-year total company EBIT of $2.5 billion and a net impact of $1.5 billion.
Ford CEO Jim Farley speaking in yesterday's earnings call. Ford did beat first quarter profit estimates, but pulled its full year guidance due to uncertainty over tariffs. Joining us for more is Bloomberg's Craig Trudell, who leads our global autos coverage. Craig, great to see you. And as it has been the case for so many companies this quarter, it's not about their past results, it's about the look forward. So what did we learn from Ford?
Yeah, there was a lot of concern about, coming into this report. GM had just warned of as much of a $5 billion impact. $2.5 billion for Ford is, of course, a much less of a hit and maybe not a huge shock because the company, produces about 80% of what it sells in the U.S. And yet this is a substantial hit for the company and speaks to just how much the parts supply chain issues are a major aspect of how and why this is going to impact the industry and impact some of the end manufacturers, where even if 80% of what you sell in the country is made in the country, the parts supply chain is so diversified, so globalized that even as Ford takes some steps to sort of mitigate this, it's really going to deliver quite a blow to their bottom line this year.
I'd imagine for Ford and GM and all the other auto companies, it's difficult to even exactly pinpoint exactly how much the damage is, given that tariff policy has been changing rapidly with the relief to stacking tariffs for autos last week. Craig, do we understand whether these are conservative estimates, whether they are worst case estimates for the companies?
I think if you were to get an honest thought about that from Dearborn, Michigan, it would be very much a wild guess, a sort of sticking your finger in your mouth and putting it up in the air. This is an issue of day-to-day negotiation with the White House, and the fact that, to your point, this has been changing so rapidly. and we've had sort of things put on, taken off, or taken off only sort of halfway. There's a lot about how these tariffs on parts are going to be applied. That's really complicated. And I would point out, even when you talk about steel and aluminum tariffs, it may be the case that Ford sources quite a bit of its steel and aluminum within the U.S. That doesn't necessarily mean that it's going to escape cost increase, because these tariffs are raising the cost of procuring steel and aluminum in the U.S. And so even if there's not a sort of direct impact here from the tariffs, there are these sort of knockdown effects and second order effects. They're also going to have an effect on Ford, and their results for this year.
A fast-moving picture, no car pun intended there, Craig. Thank you so much for joining us this morning. Bloomberg's Craig Trudell. Ford shares down 2.5% in the pre-market again after that warning of an $100.5 billion hit from tariffs. Coming up, speaking of tariffs, stagflation's coming. Apollo's Torsten Slok warning as the Fed kicks off its two-day meeting. We're going to catch up with the Apollo chief economist next. This is Bloomberg. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Earnings drag, equity futures dip as investors weigh corporate report cards ahead of the Fed's decision. And high hopes. Palantir's boosted revenue forecast fails to satisfy Wall Street expectations. And a shock loss. Friedrich Merz fails a parliamentary vote to become Germany's next chancellor. So we snapped 9 consecutive days of gains, ending the longest winning streak since 2004. We're at the lows of the pre-market session this morning, down more than 1% for your NASDAQ 100 futures, down 0.8 for your S&P. JP Morgan out with a note this morning saying the U.S. is not a good place to hide it. 30-year yields, those rise for a 4th consecutive session. They move higher in today's session of about 3 basis points, 2 for your 10-year yield after a stronger ISM reading yesterday. That meant we pared back rate cut expectations yet again. We've risen 18 basis points in your 10-year yield over the past 3 sessions, while 2-year yields, those cool off this morning, down 1.5 basis points at 381. Let's get some stocks to watch now. Here back with us is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So we are seeing Ford pretty significantly lower now in the pre-market. We're down 2.6%. The company pulling its guidance last night and warning of potentially a $1.5 billion hit to its net earnings this year alone because of the tariffs. We'll get Ferrari numbers out later as well. So a couple of big names in terms of the autos today. Then in terms of Palantir, this one in cybersecurity sliding. Company actually putting pretty decent numbers in terms of the sales, but really high expectations heading into that one. The stock trading at around 200 times price earnings. One of the most expensive stocks on the street in terms of Palantir, but coming down 8% at the moment. Finally, in the food delivery space, DoorDash doing this big deal for Deliveroo here in London, worth around $2.9 billion. Now, DoorDash already has around 2/3 of the US market, looking to expand, take a slice of the UK market. So doing that deal for Deliveroo, getting a cut price valuation on that one after a poor run for that stock. But investors probably not too happy with the price they're paying. DoorDash coming down around 0.8% in the pre-market this morning, Danny.
Joe, thank you so much. Fantastic work this morning. That is Bloomberg's Joe Easton. Now, elsewhere, the FOMC begins its 2-day meeting today with the rate decision tomorrow, but it's stuck between a rock and a hard place. Cut to combat weak growth or stay steady over fears of stagflation. Apollo's Torsten Slok writes, since the trade war began in March, consensus expectations for growth have been revised down and consensus expectations for inflation have been revised up. This is the definition of stagflation, higher inflation and lower growth. Joining us now is Torsten Slok, chief economist at Apollo Growth Management. Torsten, great to see you. And look, this is something Jay Powell talked about last month, the dual mandate possibly coming under tension. Just how acute is that tension now?
Well, exactly as you're saying, the problem for the Fed is that when inflation goes up, the Fed should be hiking. When growth goes down, the Fed should be cutting. So which one is it? Which one is that they put most weight on? And the dual mandate, of course, says that they should try to hit both goals at the same time. But the challenge really here is that they need to make a decision, of course, on are they going to put more weight on the fears that inflation will be moving higher, because we do know, because of the trade war, that inflation will be going up roughly around 1 percentage point over the next 12 months, according to the Tax Foundation and the Yale Budget Lab. So if that's the case, they should be keeping rates higher for longer. And if growth is slowing down, of course, they should be cutting. But the dot plot, Danny, to your question, is to some extent revealing that they do think that the next move should be lower. So that is, in some sense, telling you that they're leaning towards cuts.
They're leaning towards cuts, Torsten, but will we get that kind of language from Jay Powell tomorrow? Or is this a Fed that is reticent to really speak to that for fear that inflation does get entrenched?
Exactly. I think that the fear is, and this is also what Jay Powell has been talking about in recent speeches, namely that inflation is going to stay higher for longer. And given that the backward-looking data has been actually relatively solid, the non-farm payroll numbers, of course, last Friday was good. This earnings season, if you look back, has also been okay, although a significant amount of companies have dropped guidance, which of course is a very important warning sign about what might be coming. The backward-looking data can justify why they, here in this meeting that they have tomorrow, can come out and say it's just a little bit too early to pull the trigger on cutting rates.
I just wonder, though, given that the bias will be to cut, even if they're not vocalizing that, Torsten, if just this is a very mispriced market, this is something that Neil Dutta points out, that either way that they're going to be cutting for the wrong reason, they'll be cutting into stagflation or cutting into recession. And stocks only do well when you are cutting because you are achieving a soft landing. We're only down 4% this year, Torsten. Does that seem misplaced to you?
Well, I do think that, generally speaking, the equity market has been backward-looking, because the equity market looks at the last earnings season and says, well, it was not that bad, and we don't know what's coming. And it is true, we don't really know exactly at the individual company level what the impact will be, so it's hard to put the trade war into a model as an equity analyst when you think about individual companies. But at the macro level, we know very well what's coming, namely a slowdown as a result, of course, of tariffs being implemented in a way where it's going to slow down, especially small businesses. We're already beginning to see in the weekly data a slowdown when it comes to consumer spending, especially high-end consumer. We've seen a slowdown in bookings when it comes to air travel. We're also seeing motor vehicles. We're also seeing recreational travel more broadly, including lodging. So it is in the pipeline that when we get into the next several weeks, and maybe even if going into June, it will become much clearer to the Fed that the economy is slowing down more meaningfully.
When it comes to corporates, Torsten, we have to talk about your recent comments over the corporate bond market. You've been writing that liquidity for off-the-run corporate bonds has been the worst since 2020. Last week, PIMCO, not naming you, but seemingly in response, Torsten, let's just say that, saying that now is a great time to buy bonds. They point to bid-ask spreads still below the long-term average, that there have been huge trading volumes. I just wonder what you make of those statistics, and PIMCO saying now is a great time for this corporate bond market.
I was very surprised when I saw that. I mean, it's common knowledge that there's very low liquidity in credit markets. It's also common knowledge that off the runs have very low liquidity. So it is quite striking that, of course, we have normally credit markets are not functioning, at least when you look at it going back in history, simply because they're not functioning very well, simply because we have dealer inventory that is a fraction today of what it was 10, 15 years ago. So from that perspective, I was very surprised that they took up this debate with what I've been saying, simply because it is really common knowledge. It is really something everyone knows, especially for the bottom half of the market that are off the runs, that are not traded very frequently. They are really untradeable, a lot of those bonds. So from that perspective, I don't think really there is much discussion here.
Torsten, do you assume it also gets worse?
Well, what we did see in the last few weeks was that the distress and the turbulence that came along, it did make it worse. So you did see bid-ask spreads widen out, and that's not surprising. Of course, the dealer inventory, meaning Wall Street Bank's inventory of corporate bonds, has been going down in dollar terms. At the same time, the size of the corporate bond market has basically doubled over the last many years. So in some sense, when the market goes up and the inventory goes down, there's just even less bonds to be traded when it comes to the IG and also the high yield market. So from that perspective, I do think that as we go forward, if there is more distress and turbulence coming along, we should continue to see such episodes, just as what we've seen in the last few weeks, where liquidity begins to dry up.
Torsten, before we let you go, I want one last thought on this earnings season and whether or not we are about to see retailers attempt to do another round of profit-led inflation. We have heard from some companies For example, Tyson's Food yesterday really showing in their results that they're struggling to pass along higher cattle prices in the terms of their beef. But are we about to get this other round of companies saying, hey, tariffs are here, we're going to pass on higher costs to our consumer?
Well, the issue in this discussion is, of course, what exactly companies exactly will do, Danny, to your question here. And the Dallas Fed had in their survey that came out last week, when they asked both companies in manufacturing and in services, the number one response to tariffs from all companies was, we are going to pass it through to customers. So the debate really here is it 100% pass through? Is it a 50% pass through? Is it 50% at the beginning, then 100 later, or vice versa? We just don't know that yet. But it is very clear that when companies answer that question, it is going to be the case that we will see the number one response has been that there will be pass-through coming to consumers. And therefore, going back to our discussion about the Fed, we should continue to expect to see upward pressure on inflation. We're already seeing that in prices paid from the regional Fed surveys.
And we'll see what the Fed comes up with, that decision coming tomorrow. Torsten, thank you so much for joining us. Always wonderful to have you on. Torsten Slok of Apollo Management. Let's get you some other top stories now that are trending on the terminal. Friedrich Merz has failed to secure a majority in an initial parliamentary vote in a surprising setback to confirm him as Germany's next chancellor. Merz only secured 310 votes. That is short of the required 316 out of 630 lawmakers. German lawmakers will not vote again Tuesday, that according to our sources. China's services activity fell more than expected in April, the lowest level in 7 months due to the impact of U.S. tariffs. The disappointing reading will further stoke fears that the economy risks a rapid slowdown starting in the second quarter after a solid start to the year. Elsewhere, California Governor Gavin Newsom called for federal tax credits of at least $7.5 billion and a partnership with the Trump administration to help bring more filmmakers to the U.S. It's a response to the president's proposed tariff on foreign-made movies. The governor's office cited the success of California's $750 million annual program, which has generated over $26 billion in economic activity. Coming up, shares of Palantir getting hit in pre-market after failing to meet lofty expectations of earnings. That's coming up next on your Bloomberg Brief. This just out from the team at HSBC and Max Kettner moments ago, not buying it, talking about this recent rally, saying that there's been a strong rebound as positioning is still light, but as fundamentals remain dire, we are tactically cautious. So S&P 500 lower this morning, as is Palantir. Let's look at that stock pre-market sinking almost 9%. Its results disappointed investors. Palantir's revenue for the quarter was up 39%. But that was not enough for Wall Street. Joining us now is our tech lead coverage and Bloomberg Daybreak anchor, Tom McKenzie. Tom, I mean, this is the best performing stock in the S&P 500. So is this just a case of high expectations?
Jefferies analysts came out on the back of these earnings and said, look, the forward guidance, of course, they raised their forward guidance, as you mentioned, is impressive. And yet the valuation, I'm quoting from Jefferies, is irrational. And that skews to the downside when it comes to the stock performance, which, as you say, best performer on the S&P 500, of course, year to date with gains of more than 60%. The earnings came through in the first quarter, a solid beat, up 39%. The guiding for the current quarter, also above expectations, and raising their guidance. They're expecting an increase in revenues year on year by the end of this year, 36%. Again, above the estimates. The US business is performing incredibly well, but that potentially is a fly in the ointment because Morgan Stanley analysts coming out and saying, yes, the US is performing very well, particularly the contracts, of course, into the Pentagon, but also commercial. But outside of the US, the international picture is a little bit murkier for Palantir, and that is a point that Morgan Stanley's analysts landed on.
Tom, while we have you and while we're talking about AI, OpenAI walking back its for-profit plan. What was behind this move?
Yeah, look, this is a complex restructuring that OpenAI had been hoping to achieve by the end of this year to ensure that they could get the funding through on the back of this massive raise led by SoftBank, $40 billion US. I'll just take you back 10 years when they set up as a not-for-profit, funded largely at that time by Elon Musk. Then 4 years later, they realized that the build-out of artificial intelligence, which they'd started to do to benefit all of humanity, that was written into their code at the beginning of this enterprise, The build out of AI was very expensive, so they set up a unit, a for-profit unit. Since then, of course, they've raised tens of billions of US dollars. They've tried to commercialize their products, and that has led to the tension with employees, tension with former employees, tension with their competitors, and arguably tension as well with some of the attorney generals that they've been discussing with. They wanted to restructure the business to make it for profit. They are not doing that now. What they are doing is they're taking that unit, the for-profit unit, and they're making that a beneficial corporation, public beneficial corporation. But the not-for-profit will still oversee the broader organisation. So it's largely unchanged. There have been some tweaks. Sam Altman says it will still allow them to take advantage of the funding that's been committed, 40 billion, 30 billion of which is going to be coming from SoftBank. And they have also removed the caps on some of the upside gains that investors can get as well, which should and could prove beneficial to those investors. But it is not the sweeping change that Sam Altman had hoped to achieve. They've had to adjust on the back of some of the pressure they faced.
Now, I got to say, it's a busy day for tech. We even have some deal news, an environment that was supposed to be frozen. DoorDash here in the U.S. is going to be buying one of your companies over there, Deliveroo, at a $3.9 billion price tag. How did this get through the door?
Yeah, another acquisition of a UK business, and a UK business that arguably has underperformed its potential. So Deliveroo, of course, similar space to DoorDash, based here in the UK, listed interestingly at 390 pence per share. They're buying it. This is the cash offer per share, 180 pence. So a significant reduction in valuation for DoorDash if indeed this deal comes through. The board but Deliveroo are recommending it. It is still a 29% premium on the previous closing price for Deliveroo. But ever since COVID, post-COVID, like so many of the delivery companies, it's really challenged and struggled to meet the kind of expectations that many investors had. So it looks like a $3.9 billion deal could get through. What it would mean is a combined customer base of about 50 million for DoorDash and Delivery, potentially in about 40 different countries. DoorDash, of course, has about 2/3 of the market share in the US. This would be significant expansion of their international presence.
Tom, really appreciate it. That is Bloomberg's Tom McKenzie. Now let's move to Washington, D.C. President Trump told reporters that a decision on pharma tariffs will be announced in the next 2 weeks. This comes as India has also proposed zero tariffs on steel, auto components, and pharmaceuticals on a reciprocal basis with the U.S. Scott Bessent also saying yesterday that the U.S. and its administration was very close to some deals on trade. Joining us now is Bloomberg's Tyler Kendall. Tyler, how close do we seem to new deals?
Well, hey, Danny, the administration would really like to make it appear that we are inching closer, with officials telling us that we could expect something as soon as this week. But we have to keep in mind when we are talking about deals, we're really expecting more framework agreements, purchase commitments as one example, but not actually those firmer, longer term deals that we know can take months to actually clinch and work out all of the logistics. Now, when it comes to India, this isn't necessarily a surprise. This White House has really prioritized those countries that are geographically close to China, India, but also South Korea and Japan. But India in particular was made a priority, with the Vice President J.D. Vance visiting the country earlier this year, showing that this is really one of those places that the White House would like to strike a deal with as it tries to counter China's influence in the region. Now, when it does come to India saying that it will reduce its tariffs to zero on a reciprocal basis for some of those products you listed, including steel and autos, we do know it's going to take more than that. This administration is also looking for non-tariff barriers to be included in any of these preliminary outlines, as well as for larger purchase commitments, particularly with India. That's going to include boosting the purchases of U.S. LNG. It's something that the Prime Minister had vowed to do when he visited the White House back in February.
Kendall, we also heard from Secretary Scott Bessent yesterday at Milken, who made the same pitch that he made in one of his op-eds in the Wall Street Journal. The idea being that tariffs are just one piece of an overall package, that it also includes tax cuts and deregulation. That's the agenda from Scott Bessent. Do we see that actually coming from the White House in a way to appease or at least alleviate some of the concern that investors have?
Right. And Scott Bessent really has been at the forefront of trying to ease those investors' concerns, saying that they have to think holistically about this three-prong approach when it comes to how this White House is going about the long-term growth that they are promising here. The issue is that they have to work closely with Congress to get through at least one of those prongs, and that's, of course, reconciliation and those tax cuts. And that's not necessarily going to be so easy. They've set out a pretty ambitious timeline. Scott Bessent has said that he would like to see the entire package done by July 4th. That is considered to be very quick if it is able to happen. And that's because lawmakers have a lot of different issues that they need to resolve, because it's not just tax cuts that are rolled into here, but also the spending cuts that are necessary in order to offset them. And that's really where the party appears to be divided. Now, today he's going to be on Capitol Hill in front of the House Appropriations Committee. That's an oversight hearing, considered to be a smaller hearing that's going to get into things like DOGE layoffs. But tomorrow he's in front of House Financial Services, and that's going to be absolutely imperative for these lawmakers to grill him on both tariffs, but also what the administration is willing to commit to, particularly when it comes to spending cuts, because you have members in the House Freedom Caucus, for example, that are considered to be those fiscal hawks that are really pushing this administration to commit to deeper spending cuts, even if it means that some programs like Medicaid will end up being impacted. But then you have some other moderate Republicans who are already sounding the alarm that they're not going to vote for a package if it means their constituents will be impacted when it comes to benefit programs.
Tyler, thank you so much for joining us this morning. A lot to look out for on the Capitol Hill today. That is Bloomberg's Tyler Kendall. Speaking of which, we're going to have full coverage of Treasury Secretary Bessent's testimony that comes before the House Appropriations Committee at 10 a.m. Eastern. Now let's head over to the West Coast, where the Milken Global Conference is in full swing and where Treasury Secretary Scott Bessent spoke yesterday. Bloomberg's Carol Masser caught up with State Street CEO Ron O'Hanley, reacting to the comments from the Treasury Secretary that the Trump administration's work so far is solidifying the U.S. position as a premier investment destination globally. Take a listen.
I think the real question is what will happen in the future. Because when you've got that kind of position, it's very hard to imagine it getting better. And I think the challenge for the administration, which I think they acknowledge, is with this kind of uncertainty, how do you ensure that that doesn't get eroded? And right now, with all the uncertainty, I think that will cause people to think differently. But the real question is what happens when the uncertainty is over?
Well, I think it's interesting, and one of the conversations, Ron, that we had here at Milken is that what we've seen in the last few years, or for a long time, so much of the global investment dollars going to the United States, and that now what we're seeing is kind of a rebalancing as people find more opportunities elsewhere. And it's kind of normal in terms of investment rebalancing. Do you see it that way, that it's been kind of odd that so much has flowed into the United States and that that was the unusual aspect?
Well, I think a lot of things came together in the last 10, almost all periods, 10, 15, 20 years. I mean, you think about all the technology leadership, all the innovation that occurred, very, very deep capital markets, a regulatory environment that some of us may complain about, but relative to others is not bad. So all that worked in the favor of bringing a lot of investment to the U.S. And whether or not, I think that will sustain itself, but probably not at the same level, and that's not unhealthy. It's actually would be a good thing to actually see valuations in places like Europe go up, to see a little bit more diversification. But in my mind, there's not a plausible scenario where the U.S. still won't be a very attractive place for capital, maybe not at this current level, though.
One thing we love about talking with you is like 11% of kind of the investment capital, world's financial assets going through the State Street platform. Tell us about what you've been seeing over the last month or so in terms of flows, in terms of activity.
Yeah, so, and remember, the starting point was you've had an overcommitment to the U.S. now for years. You saw after the election a little bit of money flowing in, tapering off. So, and that was from non-U.S. sources. U.S. investors were continuing to invest and add to their positions in the U.S. post-election. Post the inauguration, when uncertainty started coming in, you started to see some of those numbers come down too. It's not so much that it's been redeployed to other markets. A lot of it's gone back to cash, money market funds, a little bit to gold, and which is not untypical in times of uncertainty.
The State Street CEO there speaking with Carol Masser. All right, let's get you set up for your trading day today. By the way, the conversations will be continuing at Milken. But meanwhile, Marathon Petroleum and Constellation Energy, both of those will be reporting before the bell. As we mentioned, Treasury Secretary Scott Bessent will be testifying before the House Appropriations Committee at 10 a.m. Eastern. Then Prime Minister Mark Carney will be meeting President Trump at the White House later today. That happens at 11:30 a.m. Let's take some of the moves before we get the opening bell in a couple hours' time on Wall Street. Palantir falling a lot in the pre-market. Keep in mind, this is the best performing stock so far year to date, falling some 8.2%. Constellation Energy, that's also falling 2.5%. That's ahead of earnings before the bell, with Marathon Petroleum and Duke Energy reporting. We also have Vertex Pharmaceuticals. That is extending its losses, down 3% so far. Now, in terms of this overall equity market, we're also, by the way, going to get 10-year yields. That auction will come later today as well, ahead of the Fed meeting. We are looking at futures down across the board. We heard from HSBC's Max Kettner writing with the team that they are not buying it, the rebound in equities, saying that basically the rebound has happened because positioning has remained light, but fundamentals are still dire. And that means that they do not think that this rebound can continue with these fears about stagflation. A quick check on your bond market. As I mentioned, 10 years, we will get an auction of that today. Meantime, we are looking at 10-year yields higher by about 1.7 basis points. After a strong ISM reading yesterday, you got the figures moving higher, you got yields moving higher. But some concern underneath the surface. Prices paid also moved higher. Some of the labor market data also looking weaker. Are we in an environment of stagflation? Torsten Slok was with us earlier, pointing that out, also saying that despite what PIMCO says, liquidity in this corporate bond market is getting worse. Okay, that's it for your Bloomberg Brief. Surveillance takes the reins from here. You're watching Bloomberg.